Hey folks, it's Doug Pardick with Talon Wealth Strategies, financial planner located here in Littleton, Colorado. And today is mid-March 2020, and as you know, the market is going through some tough times. But I'm an independent financial advisor, teamed up with a bunch of people with lots and lots of experience, and we've been meeting, we've been talking, all focused on making sure that we're coaching you guys, our investors, our clients, to get through these tough times and make sure the financial plan is working. And I'm here to tell you, yes, even despite what's going on, these financial plans are processed for helping you, are not affected by such events like this. If we didn't plan and we were just throwing everything in the stock market and we were not diversified, yes, this would be a very stressful time. But I'm here to tell you that this is actually a time of opportunity. But I'm going to coach you through it, and I'm going to give you a market update. We do these videos once a quarter. I'm doing this one a little bit earlier just because of what's going on with the coronavirus. So let's get right to it. So the market right now, as you know, there's a big sell-off going on. We've seen the market drop around 25% from the high that we saw in mid-February. We're about 25% off of those highs. And that's a very quick drop over a short period of time. But what I want to do is look back a little bit longer. Let's look at 2018. We had a nice drop off then, 20% drop. So similar to what we're seeing right now, not quite as quick, not quite as deep, but it was a 20% drop. And then we had this V-shaped recovery. So it recovered because the US economy was still on solid ground. Unemployment was low, job growth was good, corporate profits and corporate earnings were doing well. And eventually the market came to its senses and said, oh, the recession's not coming, we're okay, and the market rebounded. So as we sit here today, is the market gonna rebound on a V-shaped recovery here pretty quick, or are we in for more of a drawdown? And any advisor that gives you their crystal ball and tells you what's going on, I wouldn't listen to that financial advisor. We don't know what's gonna happen over the next week, over the next month, over the next 3 months. But I will tell you, despite what's going on, I do know that these prices are cheap. Corporate earnings are still doing well. So this is often, Warren Buffett, other wise investors, when they'll say when people are panicking, when there's fear out there and blood in the streets, it's the time to be buying, being opportunistic. So I do know that prices are low right now, and it's not your price. This is just temporary. And it's only your price if you decide to sell and exit out of your strategy. So selling locks in those low prices. Not a good strategy. There's one of the co-investors that I have on my financial planning team and on the investment team. He's been doing this since 1982. He has seen a lot. I've been through the financial crisis as a financial planner, but he's seeing so much more. And he gave me an analogy that just makes a lot of sense. I've heard this before, but hearing it from an actual pilot, I wanted to share this with you. So when a pilot is preparing for their long trip, they've got their plan laid out, they've been trained, they are expecting a smooth flight. However, they know that there could be disruptions along the way, and they are going to rely on that training. So when turbulence hits and the plane begins to rattle and shake, the dashboard of instruments begin to spin out of control. People in the back of the plane are screaming and there's all this noise and all this panic. A good pilot is going to remain calm, rely on their training, rely on their experience, grab onto that yoke, pull it back, and instead of staring at the instruments and focusing on the screaming in the background, that pilot's going to look out the window, look at the long-term horizon, and just be steady Eddie and fly right through that turbulence. And so that's what I want us to do. I want us to focus on the long term, not on the short term. A successful investor will take fear out of the decision-making process. So we do not want fear to rule our emotions, to rule our decision-making. That's a terrible thing to do as an investor. And you've probably seen my charts in the past. Investors on their own, they tend to be fearful and they give into their emotions. They sell when they shouldn't. They buy when things are higher, and they really lower their long-term returns down to a place that's just not going to work for a successful investor. I want us to focus on fundamentals and history, and that's exactly what we're going to get into today. So I want you to know that our team has a process and a way of managing money for our investors. As you accumulate, you're not going to have a whole lot in your bucket one, bucket two, and I'll talk about that in a minute. You're going to have most of your investments in long-term portfolios. In long-term, to get growth, you're going to be focused on things with volatility risk. Stock market, real estate that's traded in the stock market, those things are very volatile. They have great years, but they also have some pretty big drops, and that's what we're seeing right now. So that part of the portfolio is going through volatility. We're seeing drops in the prices, and it's very tough to hold on to that. I want you to know that our experienced team, headed up by Bob Maughan and staffed with certified financial analysts and just people with lots of experience, are managing those portfolios. We're looking for opportunities to buy. We're not going to be buying at the bottom, most likely. It's really hard to time that, but we're looking for bargains. And there's a lot of good companies on sale, and now is a time to load up on those shares while the prices are down temporarily. This is not permanent. This is just temporary in the short term. So for those of you that are actually looking at retiring soon, or you're in retirement, you definitely want to have bucket one, which covers your expenses in years 1 through 5, and bucket two, that's expenses for years 6 through 10. You want to have those more preservation minded. And the portfolios that we have for bucket one and bucket two have been positive year to date. Last time I checked, they were both, this was just last week, they were positive year to date and holding up really well. And this is why I love being an independent financial advisor. We're not just landlocked with stocks and bonds. There's other investments out there that have very low correlation to stock market volatility, and those investments are holding up really well. So if you're unfamiliar with these kind of strategies, absolutely give me a call, and we'll take a closer look at how we build bucket one, bucket two to get you through tough times like this. But if you're accumulating wealth and you're saving right now, you better have a fully funded emergency fund. This is exactly why we do this. If you go through a layoff during these rough times and you don't have an emergency fund, too often investors are going to go to the Roth, go to their 401k and start yanking out money at the worst time possible. And we do not want you to do this. We don't want to be selling low. And early in my investing career, my early 20s, I did this. I went through some change, and the markets were having to be down, and I didn't have anywhere else to go. No emergency fund. Nobody taught me about this. I didn't have that wisdom. And I yanked my money out of my IRA, and I realized those losses. And plus, I had to pay taxes on the money that was put in there, and a penalty too. So not a good experience. I will never do that again, and I'm trying to get as many people to not make those mistakes. So let's take a look back. So if your long-term money is going through this volatile time and it's down right now, let's kind of look at a worst-case scenario. This is going back to the financial crisis that began in 2007. We've got 3 portfolios here, and I'm focusing on, yeah, they went down, but how long did it take to get back to even? The dark blue line, that's a more conservative portfolio, 40% stocks, 40% stocks, 60% bonds. That went down, not as much, and it took about 2 years to finally recover and get back to even. And then if you look at the next portfolio, a little bit more stock exposure, it went down more, and it took about 3 years to get back to even. And for the portfolio that was completely invested in the S&P 500, so all stock market exposed, it took around 5 years to get back to even. Long term, the stock portfolio has the most wealth during this time period, but you required a lot more patience coming back out of that crisis and recovering. So just this is kind of worst case scenario. Do I think the current environment is going to lead to a 5-year recovery period? I don't think so. I think the data out there, the math in the history shows this is going to be a shorter recovery. It's going to take time. It's going to take discipline, but I believe it's going to be a shorter recovery, and we'll get into that. Let's take a look back during October. That circle on the line, that's October of 2008. And the stock market was in a big slide. I was a manager of wealth at the time for my clients, and trying to get clients to stay the course. I didn't have this bucket strategy in place at the time. I wish that I had known about that, but I did not. But those that were in the stock market, we were going through this period of just sliding. And ultimately, by the end of it, the stock market was down over 55% from the high down to the low. And investors felt a lot of pain. But it was a very tough time. And I remember Jeremy Siegel, he's at the School of Business, the Wharton School of Business and Economics in Philadelphia. And he was saying at the time, boy, stock prices are low, but they're on sale. This is the time you should be loading up on shares. So that's what I want you to focus on. So the part of the portfolio that is going down and you're experiencing this volatility on the downside, prices are low. And this is when, if we're throwing money in our 401k, we're adding money to our IRAs, or wherever we're buying these stock market type of investments, good companies are on sale right now, and you want the share count to increase. You don't want to sell out and stop your shares and go to zero. You want to have the share count increasing. And if you've got dividends, so high quality stocks with dividends, those dividends are reinvesting in buying more shares. Every time that dividend goes and reinvest, you're getting more shares. And as the price goes down and down, you're getting more shares with every dividend reinvestment or every contribution you're putting into your retirement plan. So know that your share count is increasing. Don't focus on the price right now. The price is not a good thing to focus on. Focus on the long term. Focus on having more and more shares of these really good investments. Eventually, the sale is gonna go away. The prices are gonna go up, and we're gonna wish we had got more shares before the recovery began. And I don't think this time around is gonna be nearly as bad as the Great Recession. Some sectors are gonna get hit pretty hard, but overall, the total economy, I just don't see it being as bad. That's my opinion at this point. Back then, nearly 9 million jobs were lost, and the unemployment rate shot up to 10%. That was a big deal. That was a lot of unemployed folks coming out of that Great Recession. And it took a long time to get those jobs added back to the economy. This time, I was listening to an economist just a couple days ago, and she projected that the unemployment rate, and right now, going into this, was at 3.4, 3.5%, which is historically low at 75-year lows. It's going to creep up. There's no doubt about it. There's going to be some layoffs. There's going to be some people that lost their jobs, but I think it's just going to be temporary, short-lived. But that unemployment rate is going to go from 3.4, maybe up to 3.8. Worst case scenario, 4.1%. But we don't see it going up to 10% like it did back in the last Great Recession. The consumer is healthier. I'll show you that in a second. Corporate America is healthier. Banks are well capitalized. So we're going into this in a pretty good place. Here, this shows you volatility risk. And when you're in a stock portfolio, when we go through these times, you want to know that, hey, to get long-term returns that are near double digits, stock market is a great place to be. Real estate, traded in the stock market, that's another great place to be invested for long-term returns. That's going to double your money over time, over shorter periods of time, but you've got to take on this risk. So looking at this chart, this shows annual returns of the S&P 500. So on the far left, in 1980, you see that the final return for the year was a positive 26%. However, you had to endure a 17% drop that year. And if you go out in the late 80s there, we had a year with 2% gains, but during the year, there was a 34% drop. And right now, in 2020, we're looking at about a 25% drop. And could we finish positive for the year? Yeah, it's possible. We don't know, but it's possible. We have to put up with this volatility risk. I have a whole video on this topic. Look at my YouTube channel or my website to see more about it. Okay, let's go to the next slide. So this is, I want to get into some reasons why I'm optimistic. And America always gets through these crises, whether it's a war, whether it's a recession, whether it's a pandemic, we always get through it. And corporate America finds a way to endure. And right now, the core part of our portfolios is focused on high quality stocks with over $1 billion of cash on the sidelines. And those corporations, on average, if you look at this chart, corporate America is flush with cash. As a percentage of their current assets, we're near record highs. 2008, we were not in great shape when it came to having a lot of cash on the sidelines for corporations. But today, we are. So corporations are going to get through this. And we see, and I'll show you here in a second, these pandemics, these epidemics with the viral outbreaks, the flus, they are short-lived. They don't last for years and years and years. They come and they go. They have their impact. It's terrible. People die. It's unfortunate, but we endure. We get through it. And corporate America is poised and positioned very well to get through this overall in a general sense. Some other numbers I want to share with you. Housing starts that we saw, the numbers came out in December and January, back to back. These were the best numbers that we've seen since 2007. So housing starts are increasing. In January and February, jobs added to the economy surprised us on the upside. Those numbers were really strong. And the biggest part of the U.S. economy is the service sector, which is 84% of our economy. They release numbers on a regular basis to let us know whether that part of the economy is strong or weak. The number came in at 57. So what is a 57? That's actually a good number. Anything above 50 means the economy is expanding. Anything below is saying, hey, we're going towards the direction of a recession, contracting. So 57 was a higher number than expected. It went up. And so our economy has got momentum. So the virus is here. I believe, we're going to see it expand. The infection rate is going to continue to increase. We're going to see negative headlines, which I believe is going to continue to lead to more volatility in the stock market. It's going to last for another 6 to 8 weeks. That's my opinion. We'll see what happens. But going into this, corporate America has been healthy. The consumer finances are in a better place. So consumers overall have less debt, less money going from their paycheck to pay for debt than we saw back in 2007. So we're healthier now. So that's going to help us get through this. And let's take a look back at some of the other pandemics and epidemics of the flu spreading around and its impact on the U.S. economy. So here we're looking at the Asian flu. This was in 1957 and then finally burned out in early 1958. It killed almost 70,000 Americans. So a pretty big one, pretty devastating. Real GDP, the U.S. economy, was growing at 3% annually during that year. And then the virus came, had its impact on the economy. In that first quarter of 1958, the GDP dropped by 10%. So we're definitely into negative territory. If we get 2 quarters back to back of negative GDP, that's technically a recession. So did the economy go into recession? And the answer is no. It actually bounced back fairly quickly at a good rate, 7.8% average rate of growth in the economy for the next 5 quarters. So the U.S. economy rebounded, was very resilient during the Asian flu. Let's look at the Hong Kong flu. This is another big one, 1968 into 1969. 34,000 folks died in the U.S., but the economy never went into negative territory. It actually had an average growth rate of 4% despite the impact on the U.S. economy and jobs and the loss of life. Here, most recently, one of the bigger flu epidemics we've had was the swine flu. This came in play in 2009. I believe Obama did a great job of, hey, turning this over to the experts, sending a message to the American public that we're putting our best minds on this. We're going to tackle this problem. And by the end of the year, the stock market was up 23%, despite the fact that 12,000 Americans died during this epidemic. And that included 1,200 children that passed away from this epidemic as well. And very sad, but the economy continued and the stock market continued. So looking forward, I expect the headlines to be negative for a while. There's going to be more shutdown of schools, more shutting down of athletic events. There's even talk about New York going into something like Wuhan did in China, shutting down and quarantining everybody to slow down the spread. So we're just at the beginning of the spread. And so because of this increase that we're going to see in the headlines, that's going to just keep the fear, keep the panic going. Has most of the panic sell-off happened in the market? I hope so. But short term, it's just impossible to say what's going to happen with what the individual investor is going to behave like. But I believe there's a lot to be optimistic about, looking at the past, looking at the fundamentals. And here's a movie that you may recognize. It's called The Incredibles. This was the first movie that came out. I've got a couple of young kids, and so we watched this quite a bit. But one of the quotes in the movie, played by Helen Hunter, Is it Holly Hunter? Holly Hunter. And she plays the role of Elastigirl. And she has got her kids on a plane. They're flying to rescue her husband. But the plane gets shot down. She's got to parachute down and save the kids. And the kids are panicking. They've never been through anything like this. They're very emotional. They're screaming, and she's yelling at them to stop. And she says, one thing we're not going to do is we're not going to panic. And that's exactly what I want to say to you. And maybe I'm a superhero to my kids. Maybe not. But in this case, I want to give you the same advice. We're not going to panic. So here's what we're not going to do. We're not going to panic. We're not going to yank the money out of the market and realize these losses and get out of these good companies. We're going to stay the course. We're going to buy more shares when we can. We're not going to be able to buy the bottom. We're going to buy bargains. And as we get through this, eventually this is going to turn the corner. It's going to happen. It is going to happen, whether it's in 3 months or 6 months, I don't know, but it's going to happen. And we want more shares before that does happen. And we want to own good investments. So stick with it, be patient. And remember this, short-term crises don't change the plan. 4 weeks ago, when the market was at all-time high, the plan was sound, the strategies were sound, and if we had our buckets in place, we had our emergency fund in place, the portfolio was focused on good, high-quality investments, none of the plan, none of the process, none of the strategies are bad now. Nothing's changed. We just have to give it time to run its course. We're going to be rebalancing. That's what we've been doing. We got into precious metals and gold last year. We had been getting more defensive and buying more high quality, taking on less risk. That was good for the portfolio. It didn't stop the bleeding altogether, but we're going to be looking for opportunities. We're going to take advantage of this. We're going to get through it. And on the other side, your portfolio is going to be stronger and better. And the market is going to get to all-time highs again. Is it in 12 months? Is it in 18 months? I don't know. It's going to happen, but stick with the plan. It's going to work. And call me. I'm here to help guide you through all this. And remember, don't focus on the dashboard. Don't focus on all the screaming and the buying of toilet paper and social media. This is our first virus epidemic or pandemic where social media is widespread. It's creating fear. It's getting our emotions all wacky. We do not want to make financial decisions based on our emotions and fear. We want to look out to the horizon. Know that the plan is being watched. Know that it's a good plan and our process is sound. Stick with it, but definitely call me. We're here to help. There's a whole team of us working together every day. We're talking, we're looking at your plans, we're looking at your investments. It's going to be okay. Stick with it. But again, call me if you need me. 303-951-5987. Check out my website. We've got a lot of videos we're putting up there, market updates, including educational videos. Again, we're here to help. Stay in touch. We'll see you.